All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Mark Kimbrough.
Hey.
Mark, it's 10 a.m. Pacific time here, January 17th. Markets are closed. It'll be a busy day. We have Inauguration Day because it is the 20th. And also we have the NCAA National Championship game between Ohio State and Notre Dame. Who you got in that game?
This one's easy. Go Buckeyes, and I'm going to go short Notre Dame. That's
All right.
real easy.
What about I think that half the country is probably with you and half the country is against you. So it'll be interesting. My son, I was talking to my son earlier, and he doesn't understand like the affection that Notre Dame gets and the special treatment that Notre Dame gets, and why half the country doesn't like Notre Dame because of their special treatment.
It's fair.
All right. Well, let's get into the where are we for the week here. And it looked like a pretty good week. Well, I guess it was a really good week for the stock market with all 11 sectors of the S&P 500 positive. Your worst performing sector was healthcare, up 99 basis points, so we'll call it 1%. And your best performing sector looks like it was energy earlier today, but energy and materials both up like 6.4%. So they're neck and neck trying to fight out who's going to be the best performer on the week. Just slightly behind them is financials up just over 6%. So overall, S&P up 300 basis points, or 3%. Tech up 2.5%. So a good week there from the stock market. Looking at now that we're 3 weeks or 2 weeks into the month, into the year, the only sector that's negative on a month-to-date basis is consumer staples, down 1.6%. Everything else positive, with energy up almost 10%. So big there in energy. The Russell 1000 was up 3.4% on the week. Russell 2000 up 4.2%. So small mid caps outperforming large caps. But on the month-to-date basis, kind of neck and neck, both up around 2.5%. You have growth up 2.5% also on the week, but value up 4.5%. So kind of the revenge of value, at least so far this week, and even on a month-to-date basis, value's up 3.7%, with growth up only 1.6%. So kind of a little bit of a reversal of the kind of themes that have been played out through 2024, or most of 2024. And almost surprisingly to me, their S&P equal weight up almost 5% on the week-to-date basis. So looking at the index, that's kind of your best performing index out there. Yep, showing some of that breadth out there, at least finally getting some breadth in the stock market. If we kind of shift our gaze over to the bond market, we did get the year was down 12 basis points on the week. Looks like right now it's 4.26%, and the long bond just kissed 5%. Is actually down 11 basis points on the week to close here at 484. On a month-to-date basis, it's pretty flat. You have the 2-year up 2 bips, the 10-year up 3 bips, and the long bond up 5. But that kind of that rally in rates that we did receive obviously led to a positive performance from the bond market overall. The Bloomberg Ag up 1% on the week. The agency mortgages was the best performer, up 1.4%. Investment grade corporates up 1.3%, and U.S. Treasuries up 90 basis points. So almost surprisingly, the agency mortgage market was the best performer. Usually in this type of rate rally, the investment grade corporate bonds with their longer duration would be the best performer. The agency's spread tightening must have helped a lot there. If you kind of shift over to the non-index sectors, we're up slightly, up 15 basis points or so. Emerging markets, your best, up 1%, and high yield rounding it out, 0.75% there for the high yield market. Good performance overall there from the bond market.
From inflation for that, or CPI Wednesday.
Yeah, that's right. I was just looking at it on a day-to-day basis. The 10-year rallied 14 basis points on Wednesday. So the vast majority of that rally was on Wednesday ahead of the CPI report. And then if we, bonds up, stocks up, usually in that case, we'd get commodities down, but actually commodities are up also on the week. So the Bloomberg Commodity Index up 1.5% on the week. It's up a whopping 5.4% on a month-to-date basis also. Look, on a week-to-date basis, your energy is up the most, 2.6%. Industrial metals up also 2.6%. And precious metals, Kimbrough, your precious metals up 1% there on the week. Big move. WTI crude oil up 2.25% on the week. just it touched 80. We're like 78 and change right now, but for WTI up almost 9% on the month so far. And then kind of rounding it out, gold up 1.4% to 2750, up 4% there on the month. And then Bitcoin up 10%. So a big move here. Obviously continue to do very well here in terms of up still above that $100,000 mark. And with that, kind of that's the commodity round, or that's the market roundup. There's Mark, as you mentioned, CPI, the big market mover during the week. So why don't we hit the macro side of things?
Jump into it. It's inflation week, but I'm not going to start with inflation. I'm going to start with Tuesday. We had the NFIB the Small Business Optimism Survey for the month of December. It printed at 105.1. It was 3 points above estimates and 3.4 above the prior. In general, I was going to briefly say that this is on a pretty strong sustained rally. In the last 4 months, every month's been an up month. We've been up called 13.9 points. And we got data for this metric. This is a survey, so I don't want to overemphasize the importance of this data. But this data goes back to 1974, and this looks to be the strongest rally in this sentiment indicator since at least the early 80s, at least on a sustained basis. So I just want to say it's nice to see a little optimism in the small business community, but we'll see what that actually turns into as this year progresses. Also on Tuesday, we got PPI for the month of December. Let's run through some numbers here. Good thing that everything came in below estimates. You had the month-over-month headline number come in at 0.2%. That was 2% below estimates and the prior. You had the ex-food and energy month-over-month number come in flat. That was 0.3% below the estimates and 0.2 below the prior. That all rolls into your year-over-year numbers. You're at the headline 3.3%. That was 0.2 below estimates and 0.3 above the prior. And finally, the ex-food and energy year-over-year came in at 3.5%. That was 0.3 below the estimates and right in line with the prior. Just quick summary of those, the top two numbers, those are both three handles. It's not what we want to see on inflation, but there's some good signs, at least on the horizon. Quick summary of the PPI for the month. It's actually a surprising month. About a third of the basket in PPI is goods, 2/3 is services, just like CPI, just like in its economy in general. The goods metric was up this month, 0.6%. It's up 1.8 on the year. But the services metric was flat. So this is a rare month we're seeing actually our inflationary impulse in an inflation metric come from the goods side, not the services side. But that all rolled together. The ex-food and energy on the goods side was flat. So you got a core measure on a month-over-month basis that was flat. But I want to finish this up, stay on the focus on the core here. In the first 6 months of this year, we got about 2.3% that's going to roll off this core measure. That's about 2/3 of that 3.5%. In the last 3 months, we've only seen about 4.4% in aggregate get added to the core measure. So I'm going to do some rough, wonky math here. Just say that extends. So we get 0.8% rolling on in the next 6 months, 2.3 rolls off. That's a 1.5% difference. You slap that off of the headline number, the PPI core number, and that brings you exactly 2%. Not saying we're going to get there, but the math is there for it not to be the hardest bogey to achieve. So we'll see what happens, but at least promising that, that is at least, kind of in the sights. Moving forward, that'll be a theme in a lot of these inflation metrics this week, or to start the year. On Wednesday, we get CPI for the month of December. You know what? Let's run through the numbers again. We got the month-over-month headline number coming in at 0.4%, right in line with your estimates, and slightly ahead of the prior of 0.3. You have the ex-food and energy month-over-month for December coming in at 0.2%. That is below estimates that's 0.1% below estimates and below the prior. These roll into the year-over-year numbers where you've got 2.9% on the headline, and that's right in line with estimates, and 0.2 above the prior. And you had 3.2 on the ex-food and energy year-over-year, 3.2%. That's 0.1% below both the estimates and the prior. Little hand waving for the headline number. This was a month where we actually got a positive impact from, or a contribution from, energy. It's the strongest energy move we've seen since August of 2023, but I'm not going to dwell on the headline number. I'm going to try and focus on the core here. A little more precise figures. The core month-over-month was up 23 bips on the month. That's the lowest print we've seen since July of 2024. The year-over-year measure, though, that was more interesting. It's at 3.24% for core year-over-year, for the core year-over-year measure. It's kind of been stable for the last 7 months. It's been a range, call it 3.2 to 3.3%. what's interesting about that is while that has been stable, core services has continued to be on a downward decline or on a downward trajectory. It's decelerated for the past 4 months on both a month-over-month and year-over-year basis. And the year-over-year metric for core services is now at the lowest level since Feb of 2022. That's at 4.41%. Much of this is attributed to kind of the lagged effects of shelter rolling off and the disinflation that's processing through that calculation. But in general, this downward trend is still pretty intact. So I'll say there's some hope on this CPI front. Again, using the largest roll-off prints, this base effects concept, the largest 3 prints the last 12 months that are in this year-over-year calculation, all of those are in the January to March period that are all queued up to roll off. You had an average at 37 bips on a seasonally adjusted basis, 55 on a non-seasonally adjusted basis. So there's help here from the base effects to maybe help us see a 2 handle sometime in the first half.
I did see, I was going to see, Mark, that the CPI was 3.248%. So that rounded down to 3.2. It was like, very close to rounding up to 3.3, and 3.3 was what the expectations were. So it would have been interesting to see, like, obviously we don't know, but would we gotten that 14 basis point rally in the 10-year if it was a 3.3 versus a 3.2? And, just very, very tiny little differences here, and the market expectations are changing very quickly. If we look at, like, Atlanta Fed puts out their sticky price CPI, it's, pretty sticky. Let's see, it's like at 3.7% right now. That's obviously down from, let's see, last December it was 6.7, so a pretty big move. But still kind of not getting to that 2% level. It's still staying pretty there. And then, like, the Cleveland Fed puts out their median and trimmed mean CPIs, and those are down to the median CPI is 3.8, trimmed mean CPI is 3.2. Down, they're down considerably from kind of where they were last year. At least the median CPI is down considerably. The trimmed mean is kind of around the same. But it seems like it's slowing. The progress is slowing, and I think the Fed is kind of seeing that progress slowing. That's why they're kind of pausing and want to keep things a little bit on the tighter side. But I think that the trend is still favorable. It's just going to take a lot longer.
100% agree with that characterization. Yeah. The trend is our friend. It's still it's not at the same pace of progress.
Yep.
Last thing I just want to add on that, actually, I'm going to save that. I don't want to front run for later. We'll get to it. I don't want to front run. All right. On Wednesday, also, briefly, we got the Federal Reserve to release the Beige Book. It's a once every, or 8 times a year, they release some qualitative color where they're surveying the various regions around the U.S. Quick summary, and there's some optimism growing for the economic activity. In the last 1/8 of the year, there was some stable to slightly improving labor metrics, and prices are still rising modestly, like I said, or you can say a little higher modestly, but it's just good qualitative color, good to read brief. Moving forward to Thursday, we got retail sales for the month of December. The headline number came in at 0.4% month over month. That was 0.2% below the estimate, 0.4% below the prior. Pairing back, we're going to the core version, the ex auto and gas retail sales. You get 0.3% month over month. A little weaker, but that's 0.1% below estimates, 0.1% above the prior. And lastly, you get retail sales control group. That's the one that rolls into GDP, the GDP calculation. That came in at 0.7% month over month. Strong print there. That's 0.3% higher than estimates and the prior. Don't mean to dig too deep into these numbers. Just going to say the second half of 2024 showed some acceleration relative to the first half. You could argue the third quarter was stronger than the fourth, but in general, it was still a strong set of holiday sales. I'm liking to look at the 6-month annualized rate and compare that to the trailing 20-year average, just to get a general feeling of the trend of the state. And all of those 6-month annualized basis are well outpacing their 20-year average annualized rates. So still high level. Retail sales continues to be intact. Again, 0.7% in a month on what you roll with GDP portends well for fourth quarter GDP from this perspective. Also on Thursday, last inflation data point of the week, you got import price index for the month of December. Month over month, we're up 0.1%. That was 0.2% above estimates and right in line with the prior. That rolls into the year over year number, which came in at 2.2%. Again, 0.1% above the estimate and a large 0.8% above the prior. You have 0.1 roll on, 0.8 got added to the year over year. We, not surprisingly, have a negative 0.7 rolling off. It's the base effects. This is the highest we've seen import prices be since December of 2022. Back when it was at 3.2%. But we just dealt with 3 months of very large negative roll-offs. The next 4 months, we actually have a cumulative 2.4% rolling off. Our last 3 months, we just averaged 0.1% per month. That speaks well for this number to head right on back down. So the bar is low for the import prices to fall on a year-over-year basis into the first half of the year. Again, that's a trend across all of our inflation metrics. Also on Thursday, we had initial jobless claims for the week ending January 11th. Nothing really to see here. Steady sheet drifts came at 217K, 7K above the estimates, and 14K above the prior. That brought the 4-week moving average down by 1,000 to 213K. Also, kind of similar story for continuing claims. It printed 1.859 million for the week ending January 4th. That was 11K below estimates and 18K below the prior. Briefly want to recap 2024 for the continuing claims. This has had just a series of plateaus and kind of small resets and rises. You started the year and rose to about 1.8 million in April, kind of plateaued there, had a small drop in May. Then we get added about another 50, 60K to continuing claims in the summer, added about 1.85 or 1.86 million on the range. Had a little dip in September and then rose again, added another 20K and got you to about 1.87, 1.88 million towards the end of the year. Since then, we're again having another little dip. We'll see how long that pattern wants to continue. But you have these little peaks where everyone's talking a lot about the rise in or the deterioration in employment data, and then you get a little respite or a little reprieve from it. So we'll see how that goes. But for the most part, steady she drifts. And lastly, recapping the week we got today, we have some manufacturing data, industrial production for the month of December. That printed 0.9%, 0.6% above estimates, 0.7% above the prior. Capacity utilization printed 77.6%. That was a 0.6% rise. Both from the estimates of the prior, and manufacturing production, excluding utilities and mining, printed 0.6%. That was 0.4 above the estimates and 0.2 above the prior. All in all, this was a strong month for this data. You can take a little bit out of a win. There was an aircraft manufacturer that had a strike that, ended. We got a little bit of a pickup in activity in the aerospace category with some plane manufacturing, but that doesn't take all the wind out of this. We've actually on the production ex utilities and mining, it's the first time we've had back-to-back up months since 2022. So, we'll see how 2025 goes with our manufacturing data. We're still waiting for the thaw. Maybe this is an improvement, but nothing groundbreaking. Just nice to see some positive reports on the manufacturing front. And that wraps up the week.
Always nice to see those positive reports and the optimism returning to the markets there. Looking at the Fed funds futures, we have a 0.5% chance of a Fed cut here in January on the 29th. So I think we go to the blackout period tomorrow, so there'll be no more Fed speak. Didn't really seem like there was a lot of Fed speak this week. Usually they kind of try to get in right before the blackout period, but nothing really market moving, so we won't touch on anything there. We're up to back to 1.6 cuts priced into for 2025. Moved down to 1.2 last week, so a little bit of an increase there on the back of the decreasing CPI numbers. But with that, Mark, my internet seems to be a little spotty here, so why don't you go on to the things to keep an eye on for next week?
We'll do. It's a brief week. Monday everyone's off for Martin Luther King Jr. Day. We also have the inauguration, as you mentioned earlier, but it leads into Wednesday. We have the leading economic index for the month of December. It's estimated to print at negative 0.1%. That is 0.4% below the prior. We'll see what we get. Last month was the first positive reading we had in a while, so return to negative is understandable. We also have initial and continuing claims on Thursday. I didn't have any estimates yet. Let's see if I got an update. And the answer is 215K on the initial jobless claims is the estimate. So slight decrease from this last week at 217K. Nothing on continuing claims. And then Friday we get the S&P Global PMI data for the U.S. for the manufacturing index, services, and the composites. No estimates yet for we have manufacturing. Manufacturing is at 49.8 on an estimate. That's a slight improvement, still in contractionary territory. Services estimated to print 56.3. So still strong services and just treading water manufacturing. But that's all we really got queued up for next week on a light week of economic data.
Mark, you get so excited to see an estimate for the S&P Global Manufacturing PMI numbers. So. All right. Well, with that, I think that wraps it up for this week.
Yes. Thanks to all the listeners out there today on DL Minutes. Hit us up on the X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
All right, you can find more information about DoubleLine at our website, doubleline.com. YouTube channel is youtube.com/doubleline capital. We do have Jeffrey Gundlach's Just Markets webcast up on the website. If you on the YouTube, if you didn't catch that live, highly recommend listening to that. Always very useful there from Jeffrey. We also have Jeff Sherman, his Fox Business News or Fox Business interview that's up also on the website on the YouTube. So definitely check both of those out. Very useful information there. And with that, I'd like to thank everyone for tuning in. I hope everyone has a great long holiday weekend.
Well, thanks everyone, and stay safe out there.